The financials and asset managers getting crushed this week. Our Leslie Picker tracking the action in that group. Morning, Leslie.
Good morning, Sarah. This feeds into what Steve was just talking about, because in most pockets of their business, banks actually aren't directly impacted by the tariffs. But you have the KBW Bank Index having its biggest daily decline since the regional banking crisis 2 years ago. And that is because growth in the banking industry relies on a strong economy. And as recession fears worsen due to this trade war, investors are going to sell bank stocks. Today, you can see shares of the big 6 U.S. firms adding to yesterday's steep declines. However, the volatility could benefit firms with sizable trading businesses, particularly in the equity space, FX and commodities. And bank earnings kick off 1 week from today. So we'll not only get color from the executives from these firms, but we'll also get a sense of how they're assigning the probability of a slowdown based on what they do with buybacks and how much they're reserving for soured loans. Alternative asset managers have more direct exposure to tariffs through their portfolio companies, many of which are in industrials and energy and consumer and other places that are adversely impacted by these policies. And due to the leverage on these companies, the publicly traded firms tend to have a magnified response. And these headwinds make an already challenged environment for exits, sales, and IPOs relatively untenable. Carlyle, KKR, Apollo each losing more than 20% in 2 days alone. Now, to be sure, lower rates are helpful for deployment of their capital because they make the cost of financing cheaper. And it's also worth noting that publicly traded alts generated huge gains in the stock market last year. So they are an easy target in this environment for crystallizing gains in a downturn, guys.
We think about the private equity community, Leslie, as I would argue very robust backers of the president during the campaign. And when we talk about what elements might be pushing back on the Oval, whether that's GOP senators or corporate leaders, it's hard to imagine that these wouldn't be part of that conversation.
Oh, absolutely. Using their influence there. Publicly, we've heard pretty much by and large across the financial services industry, broad-based support. It's obviously a spectrum. Not everybody feels the same way. A lot of discussions about uncertainty without pushing back on specific policies. And a big reason for that is because they're expecting this big overarching deregulatory agenda that they have been pushing for years. They say it will dramatically improve their business, who they can lend to, how they lend, and so forth. And so that has been kind of priority number one for these businesses. However, I think the calculus has always been that, tariffs have been in place, but they don't want to see tariffs really kind of put the economy in jeopardy. And so that, weighing those two elements, I think, is top of mind for executives across the financial services space.
Leslie, I wanted to ask you about hedge fund performance so far this year, because I can report, according to a source, Nelson Peltz's Triad was up 7.5%.
Yeah.
I mean, that's pretty good performance in the first quarter. That was the worst quarter for stocks in years, and they don't have any shorts. They're 100% net long. Now, they are very exposed to some of the staple stocks that held up better, and what they see as, big improvement stories like a Unilever or a Wendy's. But what can you tell us? That's got to be unusual to have such good performance in the first quarter.
Especially for being net long in this environment. That's tremendous performance. Counter that with Bill Ackman at Pershing Square, which was down about 7% year to date through March 31st. So kind of mirror images there. And he tends to be net long with some macro hedges in place. I'm not sure if he still has those on or not, but broadly speaking, his equity exposure is net long. Hedge fund performance has been really, really tricky in the first quarter of the year, and a lot of that has to do with just the overall volatility that we've been seeing, as well as some groupthink dynamics in terms of how a lot of hedge funds really piled into some of these so-called Trump trades, areas that were seen to benefit, whether it be the Mag 7, whether it be financials, which tended to unwind as we saw all of this volatility. And so it created also some magnified effects there as the hedge funds were deleveraging, Carl.
Yeah, tech a big part of that now. NASDAQ in a bear market this morning. Leslie, thank you. Leslie Picker.